Pension drawdown tax can sound complicated, but once you understand the basics, it starts to make a lot more sense. If you're planning to take money from your pension, or just want to see how it all works, here are 5 useful things to know. Number 1. You can usually take up to 25% tax-free. From age 55, rising to 57 in 2028, you can normally take up to a quarter of your private or workplace pension without paying tax. There's a lifetime limit on this tax-free portion, currently capped at £268,275. You can choose to take your full 25% upfront, or spread it across smaller withdrawals, depending on your pension provider and scheme rules. Many people use this flexibility to manage their income in a way that suits their circumstances. Number 2. After that, it's taxed as income. Anything beyond your tax-free amount is treated as taxable income, just like your salary or the state pension. It's added to your other earnings for the year and taxed at your usual rate. 20% for basic rate, 40% for higher rate, and 45% for additional rate taxpayers. If you're already receiving the full state pension, most of your annual tax-free allowance is used up. That means when you withdraw from your pension, which is available from age 55, rising to 57 from 2028, even modest amounts could be taxed. Number 3. Your first payment may be overtaxed. When you make your first flexible withdrawal, HMRC often applies an emergency tax code because your provider doesn't yet have your up-to-date details. This can mean too much tax is taken initially. You can help avoid this by giving your provider a valid P45 or completing Form P46B before your first withdrawal. If you do get overtaxed, you can reclaim it by completing an HMRC form, usually P55, P53Z or P50Z, depending on your situation. Refunds are typically processed within a few weeks. While it can feel frustrating, emergency tax is a normal part of the process and any overpayment can be corrected. Number 4. Accessing your pension flexibly affects future contributions. From age 55, rising to 57 from 2028, you can start taking flexible income from your pension via drawdown. Once you do this, beyond your 25% tax-free portion, the money purchase annual allowance comes into effect. This limits how much you can pay into pensions with tax relief from a maximum of £60,000 to £10,000 a year. The lower allowance stays in place once triggered. If you plan to keep working and adding to your pension, this is something to be aware of, as it changes how much you can save each year with tax advantages. Number 5. Your tax bill depends on your total income. The amount of tax you pay depends on your total income for the year and your personal tax code. Remember, everyone's pension journey is personal. How drawdown tax works for you will depend on your income, your age, and the way you choose to access your savings. Rules and allowances can change, so it helps to stay up to date with information from gov.uk or your pension provider.